Hello. All right, good. Hi, guys. All right, so um, first of all, how's everybody doing today? We'll get cracking here. Um, I just had major spine surgery, so sitting's a little bit uncomfortable for me. It's been a kind of a grisly time. So making that head, if we're a little bit shorter today, we're going to run a little bit shorter today, and I'll make it up to you next time. Okay. So, I want to talk a little bit about volatility today and how that pertains to risk, maybe some things to consider in your trading strategy, and what it all means, why we have such low volatility, and when we can expect that to change, signs to help you identify when that's going to change. And I've noticed sort of a dropping interest in currency trading because of the low volatility. I mean, I'll give you some stats here. I'll also give you some cool things how you can use volatility to help you in your day-to-day trading as far as predicting highs and lows of the market. And I'm not talking about predicting the middle pieces, I'm talking about predicting the extreme highs or the extreme lows. It's actually a pretty interesting way of doing things, and I'll show you some of that. Um, I remember last time there was a bunch of questions that I missed because they were in a different part of the chat. So if you have any questions, I, I think, don't they, I mean, if you just want to put them in the main chat, then go ahead with that. All right. So yeah, any questions at any time, I'm more than happy to respond to. Okay. So first things first is that a couple of rules when you're trading in a low volatility environment, right? So let me just show you what I mean by this. When I started currency trading many moons ago, how Boyki? Many moons ago, we, um, I remember these well because I remember thinking, well, this is the most attractive thing about Forex, right? One never sees, it's like anything when you start, you never see the risk. You start playing rugby, you never think about breaking yourself. You always just think about scoring tries in front of very attractive young ladies in the corner, win the game. And the same thing with Forex. I remember these numbers uh, very well. 2006, 2007, the pound average daily range is about 180 to 210 pips a day. Euro was roughly 130 to 150. The euro yen was about 160, pound yen about 220 to 250 pips a day. And, Aussie was about 110, 120, and I think Kiwi was about 100 pips a day. I mean, when last did we see a euro USD 100 pip day? It's been many moons. Right now we see, yesterday GDP, euro dropped, I don't know, 30 pips, and it was apocalypse. Right, listening to CNBC, and the CNBC is speaking to, um, CNBC is talking about how the dollar's just been smashing things and this and that. And I'm thinking to myself, what? Yes, it's been going up, but it's been slower than pond water. Okay, number one rule when you're trading in a low volatility environment is trade only with your bias. This is a good rule to have anyway. But especially when you're trading in a low volatility environment, it is absolutely imperative, in my humble opinion, to trade one directional. If you are a bear, you need to be only on the bear side. If you're a bull, you need to be only on the bullish side. All right, because if you're wrong, there's no room to be able to maneuver yourself to get out. And I'll elaborate on that. And if you're right, you don't have to go into the red too much to make yourself any money. Okay, so I've chatted to a couple of friends that trade off automated systems, and they've had a very difficult time in this environment. Very difficult. Because trading systems generally take a while to generate signals. And then in a low volatility environment, once they've generated that signal, it can be all over by the shouting, and then they're only executing the trade. All right. So when you're trading low like this, it's important to pick a level. Don't wait for too much confirmation. Take a shot and run with your bias. All right. Trading against your bias is a perilous situation in a low volatility environment. All right. So here's a very quick sum up. And this is unfortunately with this as far back as I can go on the Euro data, and it can only get me to sort of 2008. But there's some interesting things that we can learn about this. All right. Number one is that we're obviously very low. We're not at our lowest. I mean, you can see that in 2008, 2009, we spiked compared to 180. Really, the average daily range for the euro is actually closer to this. All right. It's actually closer to this 130 to 140 area. I think I agree with you. Boyka always try to go with the trend, yes. And my fundamental bias, yes. So, my fundy bias is what drives 85% of my bias, and the technical stuff will facilitate trading around that bias. And the dollar has been on a roll. If we have time, we'll have a look at it and kind of try and project our little minds into the future, Sharon, and put together a plan. If it's 250, I think that'll largely be priced into the market. You also got to remember, I don't want to deviate too much from the subject matter. You also got to remember that I think things like median income are starting to become like little trigger points for us to look at, right? Because it's one thing if we have, it's one thing if we have 5% employment and median income has dropped another 10% over a month. It tells us that only people hiring are McDonald's, Walmart, and Target, or 7 and change an hour, right? So yes, people are getting employed, but you have people with master's degrees flipping burgers, which I have no problem with. It's still employment. I'm certainly not looking down on that, but what I'm trying to get at is that the American dream is going out the window. All right. And when I say the American dream, I'm talking, a house, a car, many pickets and a fence, things like that, right? That lifestyle is becoming. So in other words, the one virtue of capitalism is supposed to be the very broad and very wide middle class, and that is becoming a thing of the past because of a significant drop in median income despite a rise in unemployment, or a drop in unemployment, I should say. So that's something to watch as a sort of a little caveat to the non-farm payroll. Certainly something that I watch because it definitely reflects, to the overall sort of health of the economy. And there's just no ways that the American economy is going at a 4% clip like GDP suggested. Just no ways whatsoever. This is a 2% economy all day long. And inflation is going to sneak up on us, but it's not going to get 4%. All right. So my point to this volatility chart is volatility is one of the few things in Forex that is 100% empirical in terms of where the absolute extremes are, isn't it? Like we know that if volatility drops on the euro to 40 pips a day or 50 pips a day, we know that is the extreme low, don't we? And we know that if it goes up to about 180 to 200 pips a day, we know that that's the extreme high on the volatility. All right? Do train traders need volatility? Well, it's actually a good question because the truth of the matter is that's what I'm trying to say is, that's actually the crux of what I'm trying to say is stick only to the trend because we're in a low volatility environment. So don't trade against the trend, because by the time you realize you're wrong, you have no space to get out with your skin on your nose still. You know, the other thing too is if you like to trade very short term, you might struggle in a low volatility environment. The get in and get out strategy very, very quickly is difficult when the euro is moving 22 pips, and we can check here. There's the biggest candle here is sort of right around the New York Open, and that is, and that's 20 pips. Yeah. Well, yes, you can raise your volume, and that is one of the benefits. It is, it's one of those things you have to be smart about, obviously, because the one day where you really jack it up is the one day where volatility is going to pump itself up and you're going to be wrong. You know how Murphy works. So you got to be smart about, it. But certainly raising your trading volume, raising your trading lots relative to the prevailing volume is smart. All right. It's important to do it at prescribed points, obviously, to mitigate your risk as much as you can. That goes without saying. But absolutely, yes. That is one way to beef up the volatility, isn't it? Is to raise your own lots, because then you're effectively raising the volatility. You're effectively raising the volatility of your trading by adding lots. Okay, so let me get back to my point. About do we need to go into why there's low volatility? I mean, I'll spend 1 minute on it, because it's basically it's fundamental. It basically pertains to who's going to blink first, right? At the moment everybody's sort of, all the central banks, and we've had this talk many times together. The central banks around the world are kind of looking at each other, and all in a paused or sideways or uncommittal sort of relationship with you going. I think we're going to be in this environment another 45, actually less than that, 3 months. I think that September, October are going to be pretty good months. And I'll give you my little expectation. I think it's going to be largely stock market driven, dollar strength. But, it's a purely fundamental thing at the moment. When do we think the Fed is going to tighten interest rates? We don't know. We have the Jackson Hole Summit next month, and we'll probably hear then-ish. And then it's likely to change 15 times before it actually happens. All right, so it's probably a ways off. All right, and things like that median income we're talking about, that's a consideration. Yes, employment's dropping, GDP's up, but is it real? Like, where's that translate to in the manufacturing sector? Not so great. Services, not so great. Housing picking up, yes. Relative to the rest of the world, absolutely. But is it really what's represented? And this is what's going on, is that we're getting these conflicting figures out of even the US, which is considered to be the one coming out of this hole the quickest. And the other thing to think about too is now we have this equity asset bubble and a strengthening economy supposedly. So where can the money go if we've got this bloated bond market, bloated stock market? You got to kind of think about how that's going to unwind itself and return back to a normal sort of economic realm, right? And that in itself is going to be an obscure kind of thing. And this, in my opinion, is where we can use volatility to help us dictate when that's going to when that's actually going to be. All right. So let me elaborate on this point because I think it's an important one. Volatility is, like I said to you before, it has extreme highs and extreme lows. If, for example, the euro got to 40 pips a day, we know that volatility is about to probably pick up on that. And guys, most times when volatility goes up, something weakens because volatility generally is a fear-orientated thing. Generally speaking, right? There's the VIX, which I'm showing you now, which is the volatility index for the S&P 500, and it's widely known as the fear index. Okay, and it shows people's sort of relative comfort in the market. And when there's a very strong correlation between the market going up and the VIX remaining low, staying low. All right. Now, let's say, for example, that the euro trickles its little way back to 34.80 to 135, and the volatility continues to dissipate down to about 50 pips a day. We're sitting around 135. Very good chance euro is going to drop from 135, given the downtrend, to 130 pretty quickly. And the extreme low volatility is a good sign of that, especially if it's made that low in volatility on the move on the upside. Okay, if you get a trickle up in the context of a downtrend coupled with extreme hits in low volatility, that's a very good sign of a continuation of the downtrend. All right, I hope that makes some semblance of sense and doesn't sound like Greek. Okay, and then the even better way for this is if you're trading stock indices, which have actually been an easier way to go than Forex. Okay, so let me show you something on my book face here, and I don't publish a lot of stuff on Forex because I'm paid for analysis and that's not fair. But I did put this out on June the 20th. All right. And I looked at the S&P 500, or I looked at the volatility index. I'm like, it has technical levels like everything else. Okay. And I'm looking at this and I'm saying, well, 1062, that's like no volatility. In other words, that's zero fear in the market. Because empirically, over the last 20 years, has the volatility index been lower? No. I mean, it might have peaked lower, like marginally, but has it really been lower than that? The answer to that is no. So what does that tell us? It says people are way too comfortable. And I realize it's a comfortable sort of trading time for stock traders. They're all very well protected. Terrible. Gold, almost no volatility, almost zero. The thing is with gold is that it's too convoluted relative to inflation, relative to an inflation hedge, relative to a safe haven when the market goes down. So volatility in gold, I do not see a discernible correlation. Not enough for me to want to put money on it. All right, so extreme lows in volatility like this tell us that people are way too comfortable despite the umbrella of free money and low interest rates for the foreseeable future. Okay, so what is this? What is this? Is this a trigger to go short on the S&Ps? Not by itself. Not by itself. Correct. That's exactly what I'm saying. Is that we are looking at, to me, the last 60 days of this low volatility, probably for a 6-month period, then I think we'll slow down again. Okay. So then I flip this is the 20th of June. All right. I'm showing you this on my book face just because I'll post it there momentarily. Okay. So then I draw this little chart up and I'm like, this is interesting. We're in this, what seems to be like a big fat channel to me. And the psych level of 2000 looming. Then I'm like, well, there's been a lot of people looking at 2000, so it probably won't get there. It's probably just going to hit the top of this sort of trend line and then make its way down to the bottom of the channel. But the big heads up is this volatility telling us, well, hang on a minute. That ain't right. That is an extreme low. Okay. So then that's June. All right. Let me cruise up here a little bit. Showing you many things here. And I pop this little chart up. And this is the 21st of July. And I noticed this on the VIX. This is a VIX daily chart. I notice that it's made what is effectively a higher low, higher high on a daily chart off that extreme low area. And I'm like, that's interesting. That's a technical change of trend on a daily basis of what we know to be an extreme low volatility area. So in other words, complacency was at its highest. Then I go to the S&Ps and I'm like, that happens to be kind of exactly where we expected it to be. And the bottom of the channel is 1930. Okay, so let's get rid of this. All right. And then we go to our S&P chart and lo and behold, we stopped around 1988 and we're on our way to 1930. Is that at all interesting? Okay. So the same thing can be applied. The same thing can be applied on the upside. So the trend is undoubtedly still up for the stock market. So I'm thinking kind of something like this. The S&P, kind of something like this. Oh no, not ready to break. Peak above sort of 2000, and then, this 20 to 25% correction. Something along those lines, right? This is the old classic, oh, it's a bear market. No, it's not. Let me go stop a bunch of shorts out. Okay, and roll over. And this will be, and this will be our first real guidance as far as raising interest rates and a little bit of tightening. Okay, but would it be interesting for you as a trader if we were sitting, say, down here, in this kind of level, support, Ray Charles support, as I call it. Anybody can see that. And at the same time, this is what you're looking at. At the same time, this is what you're looking at on the VIX. You're up here. Volatility spikes to what is the obvious high. What do you think is going to happen? What do you think is going to happen to volatility at this level with the S&P at support? There's a very good chance that volatility is going to drop at precisely the same time that the S&P is at support. So maybe the S&P, maybe the volatility index is what leads you in this. And then you can line it up fundamentally, and then you can line it up technically with the S&P chart. And then you can line it up. The yen, you see, this used to work brilliantly on the yen. When the carry trade is in full effect and the yen is just sort of trickling up every day, the volatility index is worth its weight in frankincense and myrrh. Because what happens is that when it spikes, when the VIX spikes into the 30s, you know that the stock market's basically at its lows. And therefore the yen would have corrected and it's time to get back into the carry trade and continue that. For me, trading the carry trade before the major unwind was always about trading the VIX relative to the yen. Because I can see, oh, well, VIX is at its extreme high, therefore the stock market's at extreme high. Therefore, we're probably approaching our lows on the USD yen, and it's time to get back into Aussie yen, Kiwi yen long. Okay? But, this is this is an interesting way to go. Because here we can see, okay, well, there's a level of resistance, 1950. And if I look here, I can see, yes, the bottom of support, but the stochastics will probably not be ready to cycle yet. So we're probably looking actually closer to something like 1890 to sort of 1900. And if that coincides with 1950 on the VIX, this is probably a pretty good buy to at least back to the resistance. If not, a higher high, like I said, and then sort of this 20 to 25% drop. Does this make sense? Yeah, continue to buy dollars as well. It's pretty interesting, isn't it? If those of you that have never seen how the VIX works, it's amazing. And and the reason why I say that is because Forex, there's very few signature moments where you know that cannot go higher. And it cannot go lower. And I'm using air quotes, which of course you can't see here. It's corny. Well, this is my point with it, is that you cannot use it by itself as a trigger to trade. And volatility can stay low for a while. I'm talking like 11, 12, 13. You're not interested in that. Like now, the VIX is trading at 1497. You have no interest in that because it's not an extreme high. An extreme high, we've worked out the first level is going to be around 1950, 20, and then you start to get into the 30s. Right? And in this environment, I don't see us breaking the 19.5 level, which basically translates to, 1920 on the VIX. You're talking about like 1 to 2% moves a day. It's pretty big. So that's the interesting thing, is that you don't get these remarkably low and remarkably high levels much in Forex. Like a euro could go to 93 cents and we wouldn't know if it's at an extreme low, would we? But if volatility went to 40 pips, we would know, yes, that is an extreme low. And we wouldn't know necessarily if 2,440 was at an extreme high on the S&P. But if the VIX went down to 1040, we know, yes, that's an extreme low in volatility. Now, is that low because people are feeling very comfortable and confident, or is that low because they're complacent? Then you start to look around at the economic numbers, and you're like, well, deflation in Europe, people bombing each other in the Middle East, geopolitical stuff, fungus growing on coffee. There's a bunch of things out there that can make things really weird. So it tells me, no, it's more complacency than it is real strength. Therefore, okay, I can look for reasons now to make this a technical proposition, to look for the other side of the trade, because I know it's at an extreme level. Does that make sense? It has no bearing on us in the middle of its range. None. Because I agree with you. It can trade at 13. The VIX can trade at 13 for another 6 months. And in which case, if it's doing that, I don't even look at it. But I'll flick over it, once a week and see, oh, okay, it's at so-and-so. Right. How does that relate? And then I can relate it back. And it's the same thing. It's the same thing for currency. Let me show you one more. Let me show you one more remarkable little yes, absolutely. Because whatever the prevailing correlation is at the time. At the moment, the yen in the stock market isn't necessarily correlating in terms of stock market down yen strength. I think we're going to have to see like 1.5%, 2% moves in the S&Ps to really pull the stock market down, because what's happening is that the yields are just flying up, and that's pushing yen weakness. So before, when things sort of return to a normal basis, and that's why I think we need to see sort of 2030, 2050 on the S&P, a 25% drop, and then we'll start to see a more normalized correlatory market. And I'm talking, that to me is going to take until like the frost melts off the trees in Montana next summer. We're talking like 8 months out. But it's a good lesson to know. You can see it right here. This low volatility period between sort of 91 and 96, what was this? Economically speaking, what was the major bubble at this time? It was the dot-com bubble. In this period here between sort of 98 and 2004, this was the unwinding of that bubble. This period here between 04 and 07, 08, this was the housing bubble. Wasn't it? And this period here has been the housing unwind. And this period has been the equity bubble. Okay? Now, you can just see our economic cycles for the last 20 odd years. Right? And the interesting thing is that the extreme levels to witness here. There are extreme levels to take into consideration. Yes, we spiked above here. It was an unbelievable time. But typically the very top of this is right around 40. And then the next level is right around that 30 mark. And then you start to look at the 20s. So at those three numbers, something categoric is going to happen on the stock market. And not to mention this low side. You just know it. It's a fact. These are the ranges for the last 30 years of information. So I think it's what technical indicator, the eyeball test is the first one. Right? It's just, hey, I can see that we are we've hit 43 pips a day on the euro for the last week. And I'm still seeing deflation in the market, but we've been kind of an upside trickle. The eyeball test kind of tells you very quickly that this isn't gonna hold. Right? Volatility is gonna head up. The other thing, the reason for low volatility is a fundamental one. So guidance from our central banks worldwide is the predeterminant of volatility. So when we start to get some true guidance from these guys, talk about true, like, hey, we anticipate raising interest rates. It might be wrong information, but at least it's definitive. And we anticipate raising interest rates May of 2015. That to the market is definitive information, and they're going to trade relative to that with what they have. And that in itself will be a major trigger. So really, it's less of a technical one more of a fundamental one and the eyeball test. The break of the Dow is saying to me, I'm trying to find a Dow chart. I typically watch the DAX and the Dow. I mean, sorry, the DAX and the S&Ps. I'm here, just looking for a charting chart. Okay, so all right, so let's talk about this for a minute. The issue with the equity market now, and I know this is a Forex show, the issue with the equity market at the moment is that people are saying to themselves, well, I only want to invest in things now that are economic sensitive, right? Things that are insensitive relative to the economics are being put on the shelf. For example, Coca-Cola, Yum Foods, Clorox. So stuff that people have to buy, alcohol, people are going to get hammered, whether they happy or sad. So it's not, alcohol sales are always pretty robust in good times and bad. You know what I mean? People are going to get lit up like a Christmas tree in both. So they're looking for, things that are now economically sensitive technology. So you're getting this little interbattle here in the stock market. But the net result of that, which I think has been missed, is that the fact that people are running for sectors, to me is a little bit of a change in confidence, isn't it? Because before it was just, I'll spray your money into the stock market, it'll just go up. Now it's like, okay, well, hold on a minute. We need to be smarter about this. And that in itself is the first sign that I've seen in months and months and months and months and months and months and months of, okay, well, this is now starting to become a trader's market. And that tells me that money has to move around. And that tells me that volatility is going to pick up. And that tells me that confidence isn't what it was even just a few weeks/months ago. And the first predictor of that was the volatility index, which I showed you back in June before this thing made a high. That's what I'm trying to get at. All right. That's the interesting thing. I guess it really just depends on how you, I get, let me try and answer the question was, well, the VIX and the S&P chart look a little more understandable relative to what the Dow does. I would agree with that. I think you got to remember that the VIX is calculated on the S&Ps. I mean, those are the numbers right? It's volume. The calculation for the VIX is way beyond my math comprehension. It's got many sigma things and many other different things. Well, okay. So let me just comprehensively answer this question. I'll get to yours quickly. So, to me, it's something like this. And then technically you would look for the change in direction on the VIX on the daily, and then try to look for the same sort of clues. And I'm doing this in hindsight, obviously. I did it in foresight before, as I showed you. Then I'd look for the same type of clues. You can also look on the S&P and relate that to the Dow, right? I mean, if you're going to get a short signal on the S&P, you're probably going to get the same kind of thing on the Dow. Admittedly, the S&P has been a little more robust than the Dow. Okay, now the same token goes here. The same token goes here as, if you're doing sort of something like this, right? This to me looks like sort of classic measure the trap, project that down. That's saying that there is saying that we're going to 16,300 on this run. Obviously, 16.5 was the big time level, but projection is what it is. Take a fib of the last major rise. It also corresponds to 15%, 50%. So let's say that the volatility index gets to that 20 area and the Dow's sitting here around 16,300. Yeah, there's a very good chance that we're going to do this. Right? So, that's kind of how I'd look for it in foresight. Now, if you're sitting here at 16.3 and the volatility index is only at 15, we're not done. Then the VIX is not helping us at all. Then you might be installed for something like this. Oh, another little drop. A little bit deeper than we expected. Okay. Then you can tie it up. I'm not saying that every single stock market move is tied to the volatility index. It has to correspond with an extreme level of it. But you can very easily and very quickly look at that. So my point with the VIX today is to show you, one, how to trade the indices, which have been the ticket. Currency's been kind of crummy. So be flexible to do that, right? Trade something else that's working. Then my other point is just to watch the extreme lows and volatility on your currency charts. Right? So if the euro is, like I said, if the euro drops into like the 50 range and you're sitting at resistance in the context of the downtrend, you know that that's an extreme low. And you know that generally speaking, when volatility is extreme lows, that in the context of a downtrend, that generally shows you that you're at the high in the context of the downtrend. So if you're watching the euro and you see this thing start to drop towards the 50 mark, what happened here? It shot up because the thing collapsed. Tons of dollar strength. All right. Now, the best way to use this, in my opinion, will be next summer when the carry trade comes on like it's supposed to. I think it's premature right now when it comes on as it's supposed to, because then when you are at 35 on the VIX, right, and the S&P is, for argument's sake, at, I don't know, what looks to be support, let's say 1600, all right, and on its way from, say, 15 to 35 on the VIX, the yen has dropped from, say, 106 down to 98, and you are sitting at 98 on the yen, 35 on the VIX, 1600 on the S&Ps. This would relate to about a 40 to 50% pullback window. Can you see now how you have the perfect storm for a USD yen long, or rather something like a Kiwi yen long, an Aussie yen long, CAD to a lesser extent, Euro yen to a lesser extent, pound yen long, Norwegian, South African rand long, something like that. ZAR yen. All right. It's just another tool, and it's another tool of tricks in your belt. No, I think there's going to be there's going to be stuff to trade. I just don't think you want to be like intraday running around it, is what I'm getting at. Like for me, the euro is still, when it gets to 35.50, I put more on. When it gets to 3,500, I put more on the short. When it gets to, if it goes a little bit higher, I put more. To me, you're still trading your normal trends that we've talked about the last year and a half. The pound I'm a little more agnostic about. I'm like, whatever. I think the pound's going to cruise around between sort of the 66 and 71 level. But if the Aussie, if the Aussie creeps its way much below sort of to around 90 cents, I think it's a buy. There's still stuff to trade. It's just the way you go about it's different. I don't think you're trying to get in and out. You just put on a trade and hang out and let it happen. The DAX has been the most productive thing lately just because of the volatility in it. It's already what, 200 and something more. Yeah, about 200 points today. Okay. So I hope you learned something, guys. It's it's one of those things you can go away with and play with, right? Go and have a look at it. Don't trust me on it. Go and have a look at it and see, look, wow, this is pretty cool. It's especially great in, like I said, at the extremes, not necessarily in the middle. But when things get to extremes, I've missed on predictions using the VIX very few times, just because it only hits these very extreme empirical levels a couple of times a year, maybe. And then it's not difficult after that to time the relevant trade. Okay. So thanks for hanging out with me. Thank you for listening. If you want to get a hold of me at Forex David, FOREX DAVID on the Twitter. Alternatively, I will see you guys next month and have a super day further. Thanks.